Hi, everyone. This is Victor Nunnemaker, and I'm here with John Corcoran in the latest of a series of conversations we're having to discuss investing in great companies and the digital transformation.
Awesome. Victor, thanks so much for organizing this. So, we're going to talk in this episode, particularly about market psychology and some of the different factors that affect the market. So I'm looking forward to diving into that. We've got a number of different topics. And of course, this episode is brought to you by Digital Porcupine. Digital Porcupine is your home for understanding the digital transformation, how it is affecting companies and the greater economy, and how you can take advantage and invest in this monumental change that is affecting our society and our world. Digital Porcupine does this through analyzing, dissecting, and discussing 10 great companies, just 10, that are at the forefront of this digital transformation. Now, this change is happening, whether you embrace it or not. The pandemic accelerated it by 5 years. And we're at the beginning of an exponential curve of this massive change. But good news, you're not too late to the game. The gold rush has just started and everybody needs picks and shovels. So how do you take advantage of this transformation happening around us? Go to digitalporcupine.com to learn more. All right, Victor. So, you've got an amazing background, started a number of companies, grown a number of companies, exited different companies. You're an investor, you're a mentor, you're a coach, you're a board member. But you had a tragic childhood. You had a very tough upbringing, devoid of wealth, devoid of lessons that the rich teach to their children. You were raised poor, didn't grow up learning finance or being exposed to financial literacy. How did you get started on this journey? How did you start to educate yourself?
Absolutely. I certainly am the poster child. Nobody has an excuse. If I don't have an excuse, nobody has an excuse for not investing or starting to invest. I did it the hard way, the school of hard knocks. I was raised poor, did not have a family that ever probably owned a stock or invested in anything. I made tons of mistakes. My advantage was endless curiosity and drive. I left home about the age of 15 and was fortunate to be an exchange student in Germany, where I had the first of a few incredible mentors who helped me to understand the world of business and introduced me to it. I was fortunate to get some scholarships and study economics undergraduate and then study international finance in graduate school in Switzerland, and just have my entire life, 35-ish years of investing now. I have just kept persevering and hard work and reading lots of books, everything from 30 years ago, One Up on Wall Street and Charles Schwab and Investors Business Daily, to books like The Millionaire Next Door and Rich Dad Poor Dad. Many of those you've heard of. Anything I get my hands on, and then I just made lots and lots of mistakes. And I just feel like it's incumbent on me to encourage others who are just starting off, going back in time 30 years, to teach them how to do it, because I would not be where I am without that. And then the other piece that I'd say is tracking and measuring. Nothing gets done or improves if you're not tracking and measuring it. So start keeping track of what you're doing and which companies you've invested in and what % returns you've gotten on those. The fundamentals of those companies. I have, massive spreadsheets. You don't need to have massive ones, but just track what you're doing and learn from it. My background, the biggest advantage I have in the 10 companies that I'm investing in right now is having worked at Oracle in the 90s and then having taken arguably one of the first SaaS companies public, a company called Quorio, back in July of 2000, and having had to measure the incredible compounding growth metrics and KPIs like ARR, NRR, we'll talk about some of these, ARPU, customer lifetime value, and so forth, that didn't really exist prior to that and that are now commonplace among most of these fast-growing companies that we are invested in.
I want to get into talking about those, but first, before we do, I want to ask you about some of these terms that get thrown out: market, stock, company. They're all distinctly different. I know you draw a big distinction between investing in a stock versus investing in a company. Talk a little bit about that.
Yeah, certainly. I like to say I invest in great companies. I don't buy stocks or trade stocks. A lot of people trade stocks day in, day out. I don't. I look for a phenomenal company, analyze the financials, all three financial statements, analyze the KPIs, the key performance indicators, and the growth metrics of those companies, and then I invest in a great company with the with a 3 to 5 year horizon. I intend to stay in every company I invest in for 3 to 5 years, or until they give me a reason that their growth is slowing down, or their fundamentals are failing, or that, you know, they're certainly fraud, or anything else, any other reason. And I track that on a quarterly basis. Every quarter, public companies are required to have an, file a 10Q, have an earnings call, and discuss their results. And if they continue to perform, I stay invested. And most of the companies I invest in, I do end up being in for 2, 3, 4 years. I'm looking for companies that are going to 3 to 5x themselves. I'm not looking for 5% return per year. Well, you can't even get that in a treasury right now, but you can get that in much more conservative investments. So, you know, and the market also called the beta factor is, it obviously is kind of like the tide, and this company is the swimmer in the tide. And sometimes when that tide is ebbing and going out, there's nothing your company can do. It doesn't matter how good the fundamentals are, it's going to go out, meaning the stock price is going to go down. But as long as I know that the company itself hasn't changed, that the fundamentals are still sound and is still growing like crazy, I just stick in it. I stick with it. I keep paddling. I keep, and eventually it turns around, and that company is going to grow much, much faster. And, you can see that over a 5-year track record, over 1,200% growth.
Amazing. Who should invest in stocks? You mentioned you started 35 years ago. Should everyone be investing?
Absolutely. Everyone should be. Invest something. If you're just doing your day-to-day job, job, and making an hourly wage, you will work until you're 80 or 90 or whatever. And in many regards, you won't keep up with even inflation. Certainly not the current inflation, up around 7%. But obviously, it depends on your risk profile and your risk tolerance, what companies you're going to invest in, how much you're going to put into the stock market. But my argument is that every single person, and again, I'm the poster child for that, should be investing in stocks and starting young and learning. And I'm not advocating take all of your savings and everything and sell your house and car and put it all in the stock market. That would be foolish. I'm saying start investing on a regular basis, continue to put money in on a regular basis, buy companies, study those companies, understand the fundamentals. And if you buy great companies, and I'm not saying trade, I'm not saying wake up every morning and buy a stock and sell it before mid-afternoon. I'm saying invest in a great company through the stock market. And if you can select a few 10 companies or so with really good fundamentals and really good growth, and then just stick with them, ultimately that stock price is going to follow it up. So everyone should be investing if you want to retire early, or if you want to become financially independent. That was a goal of mine, which I achieved at 33, so long time ago.
Yeah. Now, I want to ask you about, Warren Buffett has said that especially beginning investors can just invest in S&P 500 index fund. John Bogle, founder of Vanguard, popularized index funds. Why not just do that? Why pick individual companies?
But first, I would say, in lieu of investing at all in the stock market, absolutely do that. If you don't want to review some financial statements, spend 1 hour every 3 months listening to an earnings call and do the minimum amount of homework to know that you have a great company, then just invest in the index. At least you'll beat inflation. At least you'll make on average 8 or 9% over the last 100 years in the stock market. At least you'll be compounding. And compounding, Einstein has a great quote about compounding. If you understand, he who understands it earns it. He who doesn't pays it. If you're making 8 or 9% a year, the rule of 72, meaning, will tell you, divide, that in 8 years, you're going to double your money, even at 9%. At least do that. But my theory, John, is, look, I have a lot of finance and accounting background and economics. But even if I didn't, I know doctors, lawyers, attorneys, literally, bricklayers, concrete people, entrepreneurs that haven't had any finance classes, who have figured out how to analyze a company, just at least the basics, and pull out the information from financial statements to understand. And I feel like rather than buy the index of 500, call it the S&P 500 companies, I probably could do a pretty good job of picking the 250 that are better than the other 250. So why would I want to invest in the lesser half of that 500? And I take it to the nth degree and say, look, I'm going to pick the top 10 companies out of, I don't know how many there are. There's probably 3,600 or so total companies on the stock market right now. Whatever the number is, I'm trying to pick the 10 best one. And that forces me to be really, really precise. It forces me to always pick the 10 best horses. And it allows me, I think, to maximize my returns. And I'm not saying everyone can do that, but at least do a little bit of homework and pick the better companies out of the S&P 500. But if you don't want to do that, yes, definitely follow Warren Buffett's advice and just invest in the index. At least you're in the market and at least you're making 9%.
And what about how big of a position should you have in any one of those companies? Is there a point at which one of them grows larger and you decide that you need to reduce the amount that you have in that company?
So there's two questions there, whether you know it or not. One of them is how much in dollars. Well, first of all, I'd say you shouldn't have anything in the stock market that you're going to need in the next year or two, to either buy a car or pay medical expenses or pay your mortgage or do whatever. I don't ever advocate that. So each person is going to be different. So I always talk in percentages rather than in dollars. But each of you has to sleep at night, and you have to have a certain amount of money aside to be able to pay your bills. But once whatever you do have in the market, what percentage? I try not to have more than a 15% allocation, meaning if I have $1,000 or $100, I'm not going to put more than $15 into any individual one stock. And that's just that. I don't like to use the word diversification because I'm all SaaS companies. I don't diversify across industries and sectors and stuff like that. But I don't want to have too many, too much fruit in one basket, because if I drop that one basket, if something happens, if there's fraud, if that company completely falls apart, it's a massive loss. So for me, I try to keep my positions around 15%. I have strayed from that 20-25%. I did it last year on one particular company, Upstart, that because the company itself, the stock price blew up so much that it ended up being more than 20% of my portfolio, and then I absolutely got crushed on it. So I make mistakes as well, but I try to keep things around 15%. And for a 10 company portfolio, that means I'm going to have some at 15%, 2 or 3, and then some at 6 or 7%. So.
Got it. Now let's talk about timing the market. A lot of people like to talk about that, and also related concept, how long you should hold on to companies. So what are your thoughts on that?
I don't try to time the market. I know people who try to get out at the top, but then you have to try to get back in at the bottom, and you never know when that's going to happen. And it's almost impossible to be right twice. Number one. Number two, there's short and long-term tax ramifications if you're selling before 1 year that cause you to have to pay a lot more in taxes to the government. And so if it's a great company, why would you try to time that? I've never been able to accurately time the market. Now, truth be told, as things get really frothy and as my companies have gone way, way up, I might take 10% off and be only 90% invested. And then right now is a good example when the market is really low, or my portfolio is really low, and I have a lot of conviction in those companies. And I think things are far, far more likely, 80% likely to go up versus 20% down from here. I'm going to be fully invested as I am right now. So I don't try to time the market, meaning try to get all my money out at the high and then try to get it all back in the low, because then certain days, like pick your day in the last 2 weeks, when the market, when my companies have been up 10% in one single day, I've missed one of the 10 days out of the year that yield 80% of the returns. So I don't want to miss those days, and I'm in it for the long haul. So over time, eventually the tide has to come back in.
Yeah. What about, you mentioned you use spreadsheets to track your investments. How do you recommend people to track their investments, and also just kind of monitoring the news and what they should read? I know you're a big fan of participating in the quarterly earnings calls and listening in on those, or reading transcripts.
One other point regarding your last question, the third, I also buy in thirds, fourths, or fifths. That means I never get into a position all at the same time. And so that allows me to not have to try to time the market. Literally, if I like a company and I love the fundamentals, I disregard the stock price and I invest in the company that day. And it might be just a fifth of what I want to be in. And as that company continues to perform, I'll buy it again and buy it again and buy it again. And I have some companies like Datadog that I've bought it 15 times and never sold. I just keep buying additional positions as I get more and more confidence and conviction in that company. So it's another way not to have to time the market.
Then the follow-up one was tracking investments, news sources to read.
Sure. Each person's going to have to find your own news sources for what you want to read. The number one news source that I use is I just go to XYZ company, investor relations. Datadog investor relations, CrowdStrike investor relations. On that page, they're going to you can literally sign up and get an email anytime any news is released for that particular company. You're going to know when the earnings are coming out, and that's where you go to actually read the earnings report and click on the podcast to listen to their earnings call, which is exactly 1 hour long. You get to listen to the CEO and the CFO talk about the company. So that's the number one, bar none. It's not rocket science. It's really easy to find, much easier than it was 35 years ago before Google and every company having a website. There are, and then tracking your pick your KPIs. You can anyone could probably in less than an hour go through the internet or go through a couple of people, including my website, Digital Porcupine, and find 10 KPIs that they want to track on each company, and then just line them up on a very simple spreadsheet, and then just track them each quarter. See how they're doing. Are they increasing? Are they decreasing? Are they imploding? Are they going exponential? What are they doing? And without tracking it, you don't know how you're doing, and you don't know how the company's doing. So yeah, I absolutely track every single company, and all 10 companies, I listen to every single earnings call, which means I have 10 hours of work a quarter, every 3 months, to listen to those earnings calls. Not a ton of work, considering it will allow you to retire decades earlier than you otherwise might.
And, a related question to that. So, you're investing in these companies, and I want to ask about how you remain unemotional, not attached to a company, especially if you have a large position in it. How can you possibly not react to news that comes out throughout the quarter and just wait until that earnings call and make decisions unemotionally based on that earnings call? How do you do that? I'm asking, of course, for myself and for everyone listening.
With great difficulty, certainly. One of the things I've had to train myself to do is to only look at percentages and not dollars. That's important, because we all get this dollar sign in our eyes, and it causes us to be more emotional. When it's just percentages, as a finance guy, I can disregard the emotion of the dollar amount that might represent, number one. Number two, I do pay attention. Any news article that comes out, I'm going to get an email from investor relations website of that company telling me exactly what happened. If it's something fraudulent, if it is an acquisition, if it is anything of massive relevance, that stock price is going to move pretty quickly. And I can be in or out of a company immediately based on that news on that day. So I won't wait until the end of the quarter. That doesn't happen very often, but it has happened on occasion. And you do have to be careful. You have to be careful about it. Typically, the news that's coming out during the quarter is choreographed by the company. It's prepared and distributed, and it's announcement of a new product, typically don't announce new customers unless it's something big, like maybe FedRAMP approval, which is the federal government, and so forth. And those are obviously great things. And then I'm like, yeah, cool, awesome. And that's just, reinforcement to stay in the company that I'm in. But to your point, I can be out of an entire 15% position, as I was, last year a couple of times with, one company called Lightspeed, which did incredibly well for 2 quarters and then imploded. I was out completely in one day inside of 10 minutes from a massive position, and massive position for me anyway. And that did me a lot of good, because the stock price continued to implode because the fundamentals were not performing.
I want to ask about your perspective. Now, you mentioned you took a company public. You have started a number of different companies from scratch. You've sold companies. How do you approach now investing in a company's stock compared to that background, that experience? Do you have a different take on it, a different philosophy on it as an investor versus an operator?
I'm incredibly critical. I view it kind of like a horse race. I have 10 horses and I want the 10 fastest horses. So first and foremost, I try to keep it to 10. And that's not to say I don't have 10 backup horses that I'm constantly analyzing and measuring and seeing if their growth is accelerating and seeing if that company might be creating some kind of a moat or buying another company and becoming superior to one of my existing 10 horses. But we all have finite resources with which to invest. I can't keep my eye on more. I don't feel like I can keep my eye as much as I want to on more than 10 companies. And so I limit it to 10. And if I start thinking, wow, I really want this 11th stock, then I look at the existing ones and say, which one is this one going to outperform? Which company am I going to exchange it for? That just keeps me honest and keeps me, keeps me narrowed down to just 10 companies and hopefully always investing in the absolute best companies. Did that answer your question, John?
Yeah, I think so. But it kind of brings me back full circle to the original question about, who should be investing, particularly people that are, getting into the market for the first time, and that, people are always going to complain about having limited, time to invest in this sort of thing. So I guess just asking for additional context for people who don't have experience or background in investing or savings, and what you would say to them. Any further thoughts for them?
Well, 10 is just my number. I mean, invest in 2 or 3 companies. Invest in a company that you love. I mean, there's not a person on earth that doesn't know what that fruit company, Apple, is. They know exactly what it is. They probably own 10 of their products. And had you just invested in that one company anytime in the last 20 years, you would have done incredibly well over time. Invest in what you know. And I'm not suggesting invest in the companies I'm invested in. I'm trying to choreograph and pick the 10 companies that are the best picks and shovels for this digital transformation that's going on, and that are going to allow that to happen, whether it's in digitization, data analysis, data aggregation, data sharing, security, whatever it is. That's just what I'm doing. Pick a company that you know and that you understand, that's easy for you to understand, and then start learning a little bit about the financial statements. I cover some of this on digitalporcupine.com, how to read financial statements. It's super critical that you be able to measure that company in whatever means that you find necessary. Don't take the companies that I'm invested in. And it doesn't need to be 10. It can be 2 or 3 over time, and you can do incredibly well. Just make sure you're paying attention to it. Don't invest and then completely forget about it for 5 years. You might do okay if you were in Apple, but if that company gets bought out, the CFO leaves for fraudulent reasons, or something really bad happens, and I don't invest, sorry, China, I don't invest in Chinese stocks just simply because they don't have to adhere to the SEC regulations that the US companies do, and often don't. And I've been bit in the past. I've had bad experiences, so I don't invest in, for instance, Chinese companies. So, invest in what you're comfortable with.
Both of your kids started investing at 12 years old. I'm curious about what that was like, especially given your background, not having someone to show you the ropes. What was it like when your kids hit that age? How did you get them started?
They've been following my text messages and my blog for a while. I don't know if they actually read it, but every once in a while my son surprises me and says something, parrots me on something. So I think every once in a while they do. I think they were excited. I had just sold a company, and I just took a little bit of money and I pulled them together and I said, hey, here are my 10 companies. This is why I'm invested in each one. There's other companies out there, and I gave them the Nike example. I gave them the Apple example. I gave them blah, blah, blah. And I said, pick 4. I just had them pick 4 companies. And then I went on the website with them, had them push the button and actually buy those companies. I obviously had to create a stock account for them. It's a minor account, but and then I basically just encouraged them, gave them the passwords that encouraged them. You guys, initially I asked him, don't trade, don't go stock trading on me, but I want you to look at this every once in a while, see how much that grows. And the amusing part is about 18 months into it, both of the kids' 4 stocks were beating my portfolio of 10, and they hadn't bought or sold anything, and they probably had forgotten about it, and they were still beating
Dad at his own game.
But by beating, they were literally over 200% returns, which was kind of crazy to even imagine. And so
luck.
yeah, and so my daughter's incredibly creative. I don't know if she'll ever take that. My son, though, he seems very interested in it. So, but at the least I've exposed them to it. And I think eventually in time, both of them will be doing this on some level. And I don't know how anyone could ever retire early or retire comfortably without having some kind of investment like this.
Yeah. What a great story. Better than your kids getting beat down with a really bad down market to start things off.
Yeah. Well, that's true too.
I want to ask you about inflation. You mentioned it earlier. It's been all over the news. It's been a big issue lately. Talk a little bit about how that's affecting the market overall.
Yeah, sure. Absolutely. The value of the dollar you earn is decreasing every year, because as inflation soars, and right now it's roughly 7%. That's a monthly number, but year over year, the amount of goods a dollar can buy simply decreases. So if you're making $15 an hour, $20 an hour, $25 an hour, and you're not getting a raise, you're actually able to buy less of a basket of theoretical goods each year. You can't buy that entire basket anymore. You're going to have to leave something out because you're not getting enough of a raise to cover that. A perfect example is Argentina and Venezuela. Argentina's inflation was 51%, and God help us, Venezuela's was over 600%. But just Argentina, 51%. If you had $1,000 in your mattress that was not invested and not making at least 51%, you woke up after 1 year and that $1,000 was worth $500. You could only buy $500 of product with that because all the prices of everything had gone up. And that's the reason that's the reason to invest in hard assets. Maybe it's real estate for you. Maybe it's good, solid companies in the form of stocks. Something where you can at least match inflation. And so, for me, the way that I view these, the inflation, if inflation is really high, I need to be in companies that are at least beating inflation. And with at least the digital transformation companies, there are no input costs. Like, these are software companies, right? This is all electronic. There's very little inflation in that regard. So they don't have higher input costs, and maybe the price of their product goes up, but that just means that they're making more. So I feel like I'm in a really, really good sweet spot investing in these type of companies versus companies whose inputs, the materials that they need in order to build their product, have just increased by 10% or 20%.
Well, but, especially global supply chain issues have been a big issue as well.
Exactly. Simply, John, you cannot afford not to invest in hard, safe assets. If you do, and treasuries and bonds are currently making 1 or 2%. So you're not even matching inflation. So I just don't see why the smart money wouldn't be going into the stock market.
Right. Well, I want to wrap things up, but any final thoughts, anything else we haven't covered here that you want to share as we wrap up this discussion about market psychology?
The one message I would leave everyone with is to simply start investing today. Call it your MBA, the cost of an MBA. You might lose a little bit on some of those companies, but what you'll learn over time and over 20 to 30 years will help you to retire early. It's an incredible time to be alive, and the paradigm shift to a complete digitization of information, the cloud, Internet 3.0. They are the picks and shovels that are required for the transition to function in the new society. And it's exciting. I feel very, very lucky to be in the middle of it. And I do believe it's the very, very early innings.
Well, it's been amazing track record, 1,200% increase in your portfolio over the last 5 years or so. That's amazing. Victor, where can people go to learn more about you and connect with you?
Yeah, I am on Twitter for instant gratification anytime you want. Poleeko, Poleeko, at V Nunnemaker, V as in Victor, Nunnemaker, 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 or digitalporcupine.com is my blog site. Feel free to sign up. You won't get a bunch of emails. It's no cost. I do this to help teach others and mentor others, including my kids, on financial literacy and how to survive in this future financial society that we're moving towards.
Well, this has been great, Victor. Thanks so much.
My pleasure. Great to be with you. Thanks, Sean.